Hello, everyone. Today we have our last day of this website, The World in Your Pocket, just to translate it very quickly. And we have very special guests. We have here today the VP Equity Research at Morgan Stanley, Eric Woodring. And we also have the global strategist of our research area here in XP, Guilherme Giserman. Thank you very much for your presence here.
Thank you.
Thanks, Anna. Hi, Eric.
Hello.
And let's recall just a little things about the subject that we're talking here, because this is the last live we are bringing here at XP as a free content for Brazilian people to understand the profits of getting BDRs that are now usually allowed for investors to acquire to their wallets. And we are actually learning a lot about global companies. And today we're ending this subject talking about Apple, one of the biggest companies in the world, not to mention the biggest one in the world right now, and also HP, also to talk about for everybody here. And we don't really know when the BDRs are really going to be open for us, but it doesn't cost anything just to learn about them, right? So here we're here to talk. I would like to encourage everyone that's watching us right now to leave their like here in the video, subscribe on the XP webpage, and also bring your doubts. I'm here to read them. We are here to talk to you about it. And we should also thank very much XP for the simultaneous interpretation so everybody can really understand what we're talking about. Okay, so I would let Giserman begin a little bit talking about global data, a little introduction for us so we can after give the words to Eric. Please, Giserman.
Sure, thanks, Anna. Yeah, so just as a quick introduction, we've seen that tech stocks are the ones that have driven growth, not only during the pandemic, not just this year, but over the last decade at least. We know that the tech sector, the broad tech sector, let's say, it's the one that's driven results, stock performance, because they are the ones that generate EPS expansion. They're the ones that drive profits for the companies, and they're the ones that deliver growth. And more specifically, when you talk about Apple is a $2 trillion company, the first to reach that threshold, at least for in the US space. And there's a lot of talks about whether it's expensive or is there still room to grow. And I guess that's something that that's where we could start. I would love to ask Eric what's his perspective on the company right now. And we know that it's been up like 60% this year, when the S&P 500 is up just 5% over the same period. So clear outperformance here. What are the reasons? Why has that happened? And more importantly, I guess, is there still room to grow? Where can it continue to outperform going forward?
Oh, great. Thank you, Guy and Anna, for the introduction. So yes, obviously Apple, a $2 trillion market cap company, US dollars right now. I just want to start by throwing out this really interesting fact, I think. So since 1986, Apple has gone through 5 different stock splits as it's continued to appreciate in value. If you were lucky enough to own 1 share of Apple on May 1st, 1987, your cost basis would have been 36 US cents. The stock is trading at $115 today. And you would have owned 1 share at that time. Through the 5 stock splits, you would now own 224 shares. So Apple has been clearly a behemoth over multiple decades. We at Morgan Stanley have been overweight Apple for over a decade now as well. And the premise, getting to your question, is that the reason that Apple is the most valuable company in the world is that it has a portfolio of products and services that create a extremely sticky ecosystem that drives consumers to the platform and then gets them to stay on the platform. Historically, Apple has been thought of as a technology hardware company. At the end of the day, it truly is a technology hardware company, but technology hardware companies are beset by cyclical product cycles, lower margins, what I would say is inconsistency almost, because you're dependent on product launches. While Apple is absolutely dependent on product launches, the power of the ecosystem is such that Apple drives much more linear growth and much stronger growth with higher margins than your average technology hardware company that we cover. So that's kind of the quick background. If we get to the question at hand, which is what's driven the outperformance, can Apple continue to outperform? What I would say is, the stock is up strongly this year for two factors. One is the fact that Apple is expected to come out with its first 5G iPhone, the iPhone 12, next month. Historically, ahead of large iPhone cycles, significant iPhone cycles, meaning cycles where annual shipment growth exceeds 10% or more, you see clear outperformance of Apple stock in the 6 to 9 months ahead of time. This happened in 2014 ahead of the iPhone 6 launch. This happened in 2017 ahead of the iPhone 10 launch. You now see it happen again this year ahead of the iPhone 12 launch. And the reason this happens is because institutional investors position themselves early into Apple shares so that they can benefit from outperformance as one, other investors crowd into the name, and then two, expectations continue to rise, which drives positive EPS revisions and which drives positive outperformance. The second factor, and perhaps the most important factor today that has driven the outperformance, is the fact that Apple is now starting to be valued as a hardware company. So, as a platform company. So when I joined Morgan Stanley 5 years ago, the narrative was when Apple reached 15 times PE, price to earnings, you would typically sell Apple. That was peak PE. That's no longer the case. Investors have finally come to understand that Apple is an ecosystem story and not just a true hardware company. And I say that from the perspective of over 60% of Apple's revenue comes from the iPhone. In the last 12 months, iPhone revenue is down 1% year over year. However, Apple has grown total revenue 6% year over year, EPS 12% year over year, and free cash flow 24% year over year over the same time. And so it's the power of these other products, the iPad, the Mac, services, and wearables that have really been able to prove to investors that this is not just an iPhone story, this is an ecosystem story. And as a result, investors are willing to pay now roughly 30 times PE, where 5 years ago it was 15 times PE. And the reason investors are willing to pay more is because it's such a sticky product. If you think about myself, this would be the case even if I wasn't an Apple analyst. I have 2 iPhones, I have an iPad, I have a Mac, I have my Apple Watch, I have my earbuds, I have my AirPods. Probably have something else too. I subscribe to Apple Music, I subscribe to the iCloud. And quite frankly, that's what locks me into the platform. If I wanted to go buy a Samsung, I'd have to rethink about my entire technological configuration that I have at home. Or I could just buy a new iPhone and continue life as easy and as simple as it is. And so those are the really 2 main factors that have driven out performance year to date. This ecosystem story and then anticipation of a big iPhone 12 cycle coming up. What I would say, Guy, just to touch on the last point of your question, which was, can this outperformance continue? Obviously, that's what everybody really cares about right now, is yes, we would say yes. Apple has performed extremely well over the summer, somewhat surprisingly, given the fact that the world is facing the worst pandemic in over a century. But what we would say is that this summer, over the last 6 months, most of the outperformance has been driven by multiple expansion, meaning earnings revisions really haven't been as robust as you would think for a stock that's up 70%. It's really been a lot about multiple expansion. Going forward, we think that it's going to be about positive EPS revisions. And we say that from the perspective of, really, if we just think about the iPhone right now, the iPhone, we model roughly 218 million units in fiscal year 21. Consensus models about 213. Right now, Apple's supply chain is right now targeting roughly 240 million iPhone shipments in the next year. And so if Apple is truly, if the new iPhone launch is truly a high quality iPhone launch that can drive an upgrade cycle, then you should see positive EPS revisions. You need to see our estimates come up. You need to see street estimates come up. And as you see estimates come up, we expect to see the next leg of outperformance. So obviously, this isn't, there's more work to do from Apple's perspective, meaning they need to perform well this in the next 6 to 12 months. It's not just going to come from multiple expansion, but our data, and we can obviously get into this, points to a strong cycle coming up, combined with the fact that Apple's ecosystem is benefiting from work from home, learn from home trends. Services are extremely strong, and wearables are, kind of still a pretty nascent category that's growing over 30%. We think that sets the stock up to outperform over the next 12 months. And where we are today for our IT hardware coverage universe, Apple is our top pick throughout all of our 19 stocks that we cover. So why don't I stop there and let you take the floor again?
Okay. It's really amazing to hear you say that, because when we look back, and it's great that you brought yourself as an example, because I can also bring myself as an example. I remember that, and also learning about Steve Jobs a lot, that when he started making the products, the Apple products, he really wanted to change the system that technology was using back then. And it's amazing, because if you just stop using Apple stuff, either if it's a Mac or either if it's an iPhone, and you just start using another computer or another phone, you just have to relearn how to use the gadget, because you don't know how to use the things that are not from Apple anymore. So the thing that they just changed the way that people deal with technology is amazing, because now you just get attached to it. It's a habit. You just have to relearn how to use every other thing if you just give up on the gadgets that you are now used to use. So you actually just pre-answered one of the questions that I was going to ask you further, because I wanted to know a little bit about the growing system, what you expected about Apple, but you also answered even that briefly, that home office and homeschooling and home learning is actually increasing the profits and bringing better consumption of the products from Apple. But what we want to know is if there is actually a real growth of market share, and if there is really a growth of profits in the company. Because you said, and I didn't listen very well, that 5 years ago Apple was trading 15 times PE.
Right.
What is it trading right now, and what's the actually expectation of it in a long term of visualization? What do you really see for Brazilians to decide if they need to have Apple in their wallets or not?
Sure. So great question all around. What I would say, so the comment that I made was really when, not that Apple was necessarily trading at 15 times, but when we would speak to investors and it was, trading at that level at a certain point, investors would typically say, this is the peak PE. This is a stock that's reliant on product cycles. The iPhone is the majority of the revenue. And if it doesn't have a good year, you're going to see declines and declining revenues, potentially declining profits and EPS and so on. That's no longer the case. And the example that I'll provide to you is in the June quarter of 2020, in the 3 quarters where coronavirus was probably the most impactful around the world, Apple grew revenue 11%. It grew in every region of the world. It grew across every product category, meaning iPad, iPhone, Mac, wearables, and services. That's pretty amazing for a company where roughly 25 to 50% of its retail stores were closed because of the coronavirus. And so we are seeing this ecosystem story really play out. And as you mentioned, Anna, not only is Apple benefiting from the fact that it has a device in the iPhone that is an extremely popular device. Over a billion iPhones exist in the world today. But you're also benefiting from other trends. And so if you take the current environment, people are, this is my second day back in the office in 6 months. I've been working from home on my Mac and my iPad for the last 6 months. I bought a new monitor because I was working from home. People are adopting the ecosystem because they need a way to figure out how to work from home. And if they're still in the office or they're going back to the office, they realize that potentially in the future, they need the flexibility to work from home. And so they're preparing their home office or whatever it may be. Even if you're a student, you're preparing a laptop to have at home so that you can work. 50% of iPad purchasers in the last 12 months are new to the product. That's a pretty incredible stat to think about. And it speaks to the fact that you have people now adopting this product that perhaps didn't before, because there are secular forces that are driving that. But to get to your question about, what's going to happen in the future. So there are a confluence of these what I would call tailwinds that Apple can benefit from in fiscal 21, between September 2020 and September 2021. We have, between all of, the different products and services that Apple has, we have revenue growing 20% year over year next year. We have EPS growing 27% year over year next year. Apple hasn't done that really since 2017 and the iPhone 10 launch. And so even in the face of being a $2 trillion company, you're looking at growth rates for at least our world, in IT hardware that are frankly unheard of for a company of this size. You'll see it in newer, recent IPO'd companies, but not necessarily for companies of this size. And so we absolutely think that Apple is a company that will grow revenue in 2021. But importantly, I need to make sure this is very clear, is we actually think that Apple can also continue to grow beyond just 2021, right? There are secular forces that are powerful right now that can drive growth over the next 12 months. But if we think about the next 3 to 5 years, what we say is that Apple can grow revenue in the mid to high single digits and can grow EPS at the low double digits, meaning roughly 11 to 15% over a 5-year time period. Again, for a hardware company that people can think about as being a hardware company, not a platform company, those are really strong results. We don't have many companies in our universe that can do that. And so, again, it speaks to the ecosystem. It speaks to why the company has re-rated so much over the summer, but it also speaks to why we're overweight and why we're positive as we think about the next 12 plus months.
Yeah, we don't also have lots of company that's worth $2 trillion, right? So that's why I'm worried that we really have an upside in this stock. But it's amazing to hear you speak. I mean, you're really optimistic about it, and you probably see some numbers that I cannot right now. But it's interesting to hear you speak, and it makes me wonder, how do you look at the second company that we also have to talk today? Because HP could be a competitor with Apple when we talk about the gadgets, right? How do you see their performance, and wouldn't it be better for Brazilians, for example, that are just starting to have access to international market, to pick some companies that are not so pushed? I don't know how to say it, as in Portuguese we would say that, but wouldn't it be better for us to have some companies in our portfolio that are targeting to be a $2 trillion company, and not the ones that are really already a $2 trillion company, for it to say so?
Totally fair. A great question. And the way that I would kind of phrase it, or the way that I would say it, is Apple is what I would consider to be a GARP stock, a growth at a reasonable price. It's expensive, but you're paying for a stock that is actually growing at a faster rate than stocks like HP. that I would consider to be a value stock. HP, again, has a long history in Silicon Valley, in San Francisco, in the tech world. They are mainly a PC and printing company. And for that, if you think about longer term, not just the current environment, do you print more? Are you using your PC more, or are you using a smartphone or tablet more? That's kind of the dynamic that HP is facing right now, because the fact of the matter is, over a longer period of time, the PC is a mature business. The printing is a mature business, and so these aren't, and they're not as, I guess, there aren't as many changing dynamics in those markets, and so. HP is a stock that we have revenue declining 5% this year. We have it declining roughly 1% next year. We think about it as a GDP plus or minus type grower, meaning it can grow 3%, it can decline 3% in any given year. The market share changes aren't all that drastic. So it's harder for HP to outperform. And whether or not this, what I'm about to say is fair or not, it doesn't get the benefit of the doubt. Meaning institutional investors in the US look at HP and they say, your end market exposure is to the mature PC market and the mature printing market. Yes, your stock is cheap, but why do I want to own you if that's actually the case, if those are your end markets? Historically, they have actually outperformed. They take share in both markets. They are the global market leader in the printing market. They are the number 1 or number 2 market share leader in the PC market. They have a very strong defensible position. The problem is that these are not necessarily markets that are growing. And so it's our job, it's really their job, I guess I would actually say, to convince us and to convince the investing public that they can sustain share gains, that they can sustain growth, and they can cut costs, and they can buy back and return cash, such that a value stock becomes less of a value stock, and you can see outperformance. What I would say right now, just to briefly touch on it, on the near-term factors impacting HP. Clearly, right now, like with Apple, you have this work from home and learn from home and teach from home dynamic. That's really important for HP. In the just end July quarter, HP's PC business grew 7% year over year. Again, that's really, really strong for a mature business. On the other hand, PCs are a very low margin business, roughly 3 to 5% operating margins. Printing, on the other hand, is a much higher margin business. And for HP, it's roughly 16 to 18% operating margins. But if you think about the current environment, most of the world prints from the office. Most of the office is empty right now. And so the question that HP investors or prospective investors are left dealing with right now, and part of the reason why we are equal weight on HP right now, is the fact that the next 12 months from a printing perspective are quite frankly up in the air. The pace at which workers come back to the office will really dictate how well the printing business does. Some people are calling for the death of printing, meaning why buy a printer when you can just buy a new monitor? I think that's a little far-fetched, but the data right now shows that there is a very shallow recovery in printing volumes, and that's not really expected to improve all that much through the end of the year. And so, the reason we're equal weight HP and the reason why we would say buy Apple over HP is there is a clear path towards growth, towards a re-rating for Apple, and there are clear catalysts coming up. First is the iPhone launch next month. For HP, there are opposing forces, meaning the PC is a tailwind, the printing is a headwind, and they will be returning cash, so that is a positive story. But until you see their higher margin printing business actually gaining some sort of traction, we think this is a stock that, it's not necessarily a value trap, but it's a cheap stock that will remain cheap until there's confidence that there can be some sort of recovery. And at this point in time, I don't think there's that confidence.
Well, Eric, let me just go back to Apple a little bit. So you mentioned a few things, right? You touched on the hardware story and how Apple was making the transition to being a platform and to offering services, which is obviously a higher margin business. It's a higher growth business, and it's obviously something that they want to be positioned in. And we know that the whole AirPods thing and how it's huge, and the company, on one hand, it's good because it added a lot of value to the company, but on the other hand, it could be perceived as adding to that image, right, of Apple being a hardware company. And then now they're trying to make this transition, and there was a product event yesterday. Yep. And they've announced a few things, new Apple Watches, and I know that Apple Watch goes along with the theme of improving, of getting to innovations in healthcare. Tim Cook said himself that he wants Apple's greatest contribution to humankind to be in the healthcare space.
Exactly.
What was announced yesterday? What was relevant, and how does that impact your thesis? And spoiler alert here, we know that the new iPhone, that 5G was not announced. And what would you say? When is it coming? Do you have high expectations for it? And could it take the iPhone story back to growth?
Great questions all around. So yes, Apple hosted a product event yesterday. It's unusual for them to host two product events in one fall. Typically they include all of these launches in one event. But what you saw yesterday was Apple launch two new Apple Watches. So the Apple Watch Series 6, the new flagship Apple Series watch, and then the Apple Watch SE, which is a cheaper, I guess I'd call it an entry-level Apple Watch. You also saw them launch two new iPads, the iPad 8th generation, which is the $399 kind of low-end model. And you saw them launch the iPad Air, which is $599. And earlier this year, they launched or relaunched the iPad Pro, which is $799 or $999 US dollars, depending on the display size that you buy. Finally, and so those are the hardware launches. They also introduced new services. They introduced Apple Fitness Plus, which is absolutely a reaction to what's going on in the world. Meaning it is a virtual platform where you can get fitness coaching, you can get access to classes, whether that's running, biking, cardio, climbing, and so that's absolutely a new service from Apple. And then lastly, and probably most important in our mind, was this Apple One, which is essentially a bundled services launch. And so, for example, for an individual Apple One service bundle, you pay $14.95 a month. You get access to Apple Music, Apple TV, Apple Arcade, and 50 gigabytes of iCloud storage. The professional or the premier version is roughly $30. And you get access, in addition to Apple Fitness, more iCloud storage. And so what I would say is, yes, Apple is launching new hardware, clearly. 2020 is perhaps the most prolific year for hardware launches in Apple's in the last decade, meaning you're going to have a completely new iPhone portfolio. You have a completely new iPad portfolio from the low end at $399 to the high end at $999. You will have a new Mac launch later this year with custom silicon, meaning Macs that have semiconductors designed by Apple. That is new. You will have clearly a new Apple Watch, both at the high end and at the low end. It's expected that Apple will come out with new AirPods and perhaps even overhead AirPods called AirPods Studio. And so if you look at those product launches, those are new products that touch every single product category that Apple has. Apple doesn't typically do that every year. And so that's why I make the comment. But really, again, I talk about this ecosystem. It's extremely important. Absolutely, it contributes to why the stock is valued where it is. But again, I would be remiss if I didn't, spend more time on the iPhone. Again, it's 60% of revenue, and we're coming up on a year where we'd say we're expecting extremely strong growth from the iPhone. So if I just back up quickly, coronavirus, we all know what happened in the beginning of the year was really where in China, the supply chain was impacted. And so because of the impact from coronavirus in the supply chain, essentially you didn't have workers that were able to travel back and forth between China and the US, and the development of the iPhone 12 models was delayed. Typically, Apple would launch an event right around now to launch the new iPhones. That's not the case. What's likely the case is that Apple, it's known that they're going to launch the new iPhones, but the expectation is that they're going to launch next month in October, and potentially be available for, at the end of October, but absolutely ahead of the holidays. The reason, what I've said so far is I've talked about 5G. Well, why is 5G important? It's not, 5G is obviously the next generation cellular network. If you think about a hose of data, the hose not only will flow faster, it'll have a larger circumference, so you'll be able to capture more data more quickly. And so, we are really still at the early days of 5G. And so I don't want to, I want to emphasize that 5G is absolutely important, but historically, network upgrades haven't been significant drivers of iPhone upgrade cycles. It's actually been form factor changes, meaning the form of the phone looks different. And that can be from new batteries, that can be from new cameras. And so when I talk about this upcoming iPhone launch, yes, the inclusion of 5G is absolutely important, but you're going to get more than just 5G. So for example, historically, before 2017, Apple had launched 2 iPhones at a time. In 2017, they changed that to launch 3 iPhones. In that year, they launched the iPhone 8, the iPhone 8 Plus, and the iPhone 10. This year, they're launching 4 new devices. And so you're going to get 4 new iPhones at 3 different sizes, which is, again, unheard of for Apple. And so you're introducing 5G. Now you're introducing 4 new iPhones priced at very different price points. Some of them will have triple cameras on the back. The lowest end model will have a dual camera on the back. They will all have the A14 Bionic processor, which is going to be Apple's latest processor, which will be some magnitudes faster. We don't know right now, but it will absolutely be a faster device. There'll be a time of flight sensor now on the highest end iPhones, meaning on the back of your phone, you'll have a new sensor that will allow you to basically capture AR or VR like scenarios or renderings more accurately. Again, on its own, not necessarily all that interesting, but when you include it with all of the changes that Apple is making to the iPhone, it sets you up for this new iPhone that is really, in our mind, more revolutionary than evolutionary. Meaning you're taking a step function change versus repeating something from last year. And so for those reasons, we're absolutely bullish on the iPhone 12 launch. I just need to mention 2 other factors quickly. One is the fact that earlier this year, Apple did come out with the iPhone SE 2 in April. That is the lowest end iPhone model. It is for customers that are more price sensitive. It's priced at under $400. That has been doing well. That has been performing well, especially in Europe. It has been capturing market share switchers in Europe, and so that's positive. And so the reason I bring it up is because Apple hasn't had the SE2 for a year yet, so it's still technically a new model, and it will still contribute in fiscal 21, meaning next year. The other dynamic is the fact that 5 years ago, Apple used to rely on carrier subsidies to help us consumers buy a new phone. Spending $1,000 for a new iPhone isn't exactly the easiest thing to do for the majority of consumers in the world. Subsidies are back, meaning Apple's trade-in program, which used to be focused on recycling the device to responsibly get rid of old parts, is now a subsidy program. And so if you think about this year buying the iPhone 11 Pro in the US, it costs $999. If you turn in an old iPhone, you can get roughly $200 to $350 for it. So you are spending, call it roughly $600 to $700 on a new iPhone now. And then if you think about it, you can now pay with 0 interest financing over 24 months for the device. And so instead of paying $999 up front, you're paying roughly $35 per month for 24 months. that's a lot easier to think about and a lot easier to stomach to buy an iPhone than saying I need to spend $1,000 up front. And so for all of those factors together, they all contribute to why we are bullish on the iPhone 12. Obviously, the launch coming up next month.
Great stuff. Thanks for that. So let me just get on the App Store topic, which is pretty sensitive right now. We've seen, it's been making headlines, not necessarily for good reasons. And then, it's facing antitrust investigations in the US and Europe. What's the latest here? Where do you stand on this? And also, if I could just add the story which is correlated, there is the whole Huawei restrictions and 5G in the context of the broader trade war, right?
Yes.
And then we know that Huawei is the world's largest smartphone producer, but it imports 90% of its input from the US and from Taiwan. So this is I think it's an important topic we should address.
Yep,
I'd love
absolutely.
to get more color on that.
So let me touch on Huawei quickly, just because it relates to the iPhone narrative that I just provided. Huawei has absolutely been a powerhouse in the smartphone world, especially in China. That they produce multiples more models than iPhone does, both at the high end and the low end. They already have a 5G device. They actually have a flip phone, a foldable smartphone, and so they are absolutely a force to be reckoned with. But the stance of the Trump administration is that obviously there have been complexities with geopolitical relationships between the U.S. and China, and whether it's right or not, Huawei is somewhat the poster child of Chinese, successful Chinese technology, specifically telecom infrastructure. And so the U.S. government has put restrictions on Huawei. From Apple's perspective, that is beneficial. Obviously, if you have one of the two largest smartphone manufacturers in the world that is facing, real headwinds from not being able to access U.S. technology, that's really hard for Huawei. Again, you have to think about them kind of rejiggering their whole supply chain. We've already seen that they've had to create their own operating system now because they don't have access to Google's Android operating system, which is what historically had powered their phones. And so there's a lot of changes going for Huawei. Apple can absolutely take advantage of that. What I would say is Huawei is big, is obviously not big in the US, but big in markets outside of the US, especially in China. And what we're trying to figure out right now is just, if we went to a Chinese consumer and said, you cannot buy a Huawei device, what device would you choose? We're trying to figure out what the answer to that question is. Because historically, it's been split between Apple and then some of the other domestic Chinese vendors like Oppo or Vivo or Xiaomi. And so the answer to that question helps us understand what type of share Apple can gain. But make no mistake about it, we would say that the fact that that Huawei is negatively impacted by these technology restrictions is a net benefit for Apple. To your first question about the App Store. So if we back up, the App Store is the largest segment within Apple's services business. And Guy, as you mentioned before, services is roughly twice gross margin of Apple's hardware business. So a very important business, both from a growth perspective and from a profitability perspective. The App Store has been on fire recently. And you can think about that same reason that the work from home trend is so powerful, and that is we've been sitting at home and we've been interacting with our devices more, and that means we've been using the App Store more. And whether it's the App Store or Google Play, they've both benefited. But quite frankly, the App Store has been growing very strong. Call it in the month of July, it was up 29% year over year. In the month of August, it was up 24% year over year. And so, 22% year over year. And so this is a business that is vitally important to Apple. But as you mentioned, it's been in the news for the wrong reasons. It's facing several antitrust investigations. Let's kind of dissect that quickly. First of all, I am absolutely not an antitrust lawyer. I am not smart enough to be an antitrust lawyer. And so I can't speak to the specifics of those investigations. But what I would say is that Apple is being looked at from an antitrust, or the App Store is being looked at from an antitrust perspective, because some developers, specifically high-profile developers, believe that the 30% that Apple charges on in-app purchases and app downloads is too expensive. Google Play charges the same amount, so just so we're clear, that is kind of the standard right now. And what we would say is that there are some developers, like Epic Games is the latest with Fortnite last month. YouTube was one originally. Spotify is big in Europe. That they kind of started the antitrust investigations in Europe. What we would say is that Apple delivers or provides a service for the revenue or the take rate that they collect from developers. Meaning, there are 23 million developers on the Apple platform, on the App Store platform. There are less than 10 of them that have publicly complained about pricing in the App Store. So from that perspective, we would say that it's the minority of developers on the App Store platform that complain about pricing. It's also important, 84% of apps on the App Store are free to download, free to use. Meaning 84% of apps Apple collects $0 from if us, as customers download whatever app that is, use whatever app that is. So that's kind of the first point that I would make. The second point that I would make is just that the other antitrust angle is that developers are saying Apple's closed infrastructure, closed ecosystem doesn't provide for competition. Meaning, if I have an iPhone, I can only have the App Store. I can't have the Google Play Store. I can't have my own native App Store. For Epic Games, for example, was the one that wanted to have their own native App Store. They were kicked off the App Store. For Apple, it's all about the user experience. That's what it gets down to. That was Steve Jobs' original kind of mission, was to provide this really simple but high quality user experience. Apple's belief is that if you have unregulated, it might be a bit of a strong word, but if you have third-party app stores on the iPhone or on the iPad or on the Mac, then you are introducing undue risk to the user, meaning there could be malware that is introduced. Right now through the App Store, Apple reviews every single app that is submitted. There are over 100,000 apps that are submitted weekly. Apple reviews all of them. And so they have a very, very tight and secure App Store that they know is high quality and not prone to risk for the consumer. If you introduce a third-party app store, you introduce risks. And for Apple, they're saying, well, we quite frankly, we don't want to introduce that risk to our users, because then we think that the user experience is lower quality. And so, again, not pretending to be an antitrust lawyer, but these are some of the dynamics that we think that are important that investors need to realize when they read negative articles about the App Store. Is yes, they're absolutely facing risk. Yes, in some cases there are absolutely antitrust risks, but there are also positives to the strategy that Apple takes from the App Store. And so I feel like it was important to mention those. The last thing that I would say when it comes to the App Store is, again, they've been accused of having kind of monopolistic behavior. Apple has seen 200 basis points of gross margin contraction over the last 5 years. They've grown OPEX, or had to spend on OPEX, roughly 10% growth annually for the last 5 years. And they do that because they're constantly investing in their platform to make sure that it is this secure, high quality user experience that everybody loves, knows, and is looking for. And so from a monopolistic standpoint, that cost pressure doesn't really necessarily reflect someone that's in a position that would be known as monopolistic. Yes, they have significant market share in the app economy. Absolutely. Yes, there are some cases where they can charge less for their apps than competitor apps. Absolutely. So I'm not saying that there isn't risk, but what I'm saying is that there are two sides to the story, and it's a very complicated topic. And quite frankly, when you're dealing with legal cases, especially in the U.S., these things take forever to go through. So Apple's been involved in a number of antitrust lawsuits or patent lawsuits in their time. They last roughly 3+ years. We're not even a year into this, antitrust investigation into Apple. And so what we would say is, from an investor standpoint, there is absolutely a risk, okay? But in the next 12 months, we don't think that there's necessarily going to be anything that you're going to learn that will be detrimental to you as an Apple stock owner. So what we would say is, again, because we take this 12-month view, yes, there's a risk, but is it a near-term risk for you as an investor? No, it's not. Is it something you need to pay attention to? Yes, absolutely. But in the near term, in the next 12 months, we don't see it necessarily being a risk, and the App Store is growing strong. And so that's kind of the position that we would take on the App Store at this point in time.
Sounds good. Makes a lot of sense. And we could talk about Apple forever, for 5 hours straight. There's so much.
I've done it for 5 years.
You've been talking for 5 years, exactly. And one concern that I see is that it could be systemic, right? The whole App Store episode, if Epic Games win, then it could be systemic in terms of other brands, other apps coming up with complaints as well. But let's move on quickly to let's switch over to XP, if I may. Just wanted to ask, we touched a little bit on the future for Apple and what's in store for them for the next 3 to 5 years, and also what's even not in the models that could drive growth going forward. But what about XP? What's the future of the printing business for you? And I guess an even better question is, what's your bull and bear case for the stock?
Yeah, so it's a great question, and I touched on it earlier, but let me just kind of retouch on each one of them. So for the PC business, HP is the number 1 or number 2 market share leader in the world, next to Lenovo. They are a share gainer, have high quality product. What I would say is that we think of the PC market as being a -3 to +3 annual, grower decliner. And with HP taking share, that means, HP can grow their PC business or see growth or declines of roughly 2 to 4%, roughly on an annual basis, depending on the product cycle, depending on the year and whatnot. So that's the PC business. Right now, obviously, as we talked about before, the PC business is doing extremely well because of the tailwinds that you have from work from home. We don't expect those to subside anytime in the next 6 months. Maybe they won't be as powerful as they've been in the last 3 to 6 months, but there's absolutely going to still be tailwinds as as essentially the world realizes that perhaps we need to prepare for something ahead of time, what we've heard increasingly is that you have more families that are saying, 1 device per person, rather than just having a desktop at home that serves a family of 5. You now have 5 laptops at home. Again, that's not true everywhere, but that's the narrative that I'm trying to speak to. That's why you're seeing strength in the PC business. The printing business, there's a much bigger question mark. Again, a lot of the majority of the world prints from the office, and the return to the office in many regions, kind of outside of Asia right now, it is somewhat unclear. And so, because of that, what we would say is the printing market was already somewhat of a shrinking, a melting ice cube. Coronavirus can actually probably melt that ice cube a little faster. You may see a recovery in 2021, a bit of growth because you're coming off of really easy comps and you have a recovery, and you may have more people in the office. That's still to be determined. But it is still probably longer term a melting ice cube. HP does take share. They are the market share leader. They have roughly 45% market share in the printing market, but they do have exposure to the home, and to a certain degree, you do have these tailwinds to home printing as well, right? If you're working from home and you want to print, you need to get a home printer. You can't print in the office. So there are puts and takes there, but overall, I would say that the outlook for the printing business is definitely more questionable, is definitely a little more negative than the PC business. And so for that reason, we're kind of stuck in this middle of the road equal weight rating on HP. It's cheap, but it's somewhat cheap for a reason. And until we have clarity on the path forward, we don't necessarily see a path towards significant outperformance, but at the same time, we don't see a significant path to underperformance.
I'm not saying it's the case, but you don't want to buy cheap companies that make typewriters, right? That are going to be obsolete pretty soon. I'm not saying it's the case,
Yes.
but it's an extreme.
Absolutely.
It's an illustration.
It's an illustration, but it's absolutely a representative illustration. But to get to your question, which was, what's the bear case? What's the bull case? The bear case is somewhat of an easy one, and that is somewhat of the death of printing. It's not that printers go away. It's just that everybody prints less. We use iPads more. We use a second monitor more. Or people think more about the environment and say, hey, I don't want to print 100 pages. I'm just going to print 5 pages and I'll look at the rest on my computer. I don't think we're ready to call that, but that contributes to the bear case. The other bear case, the other contribution to that bear case would be, hey, the PC market has done really well for a long time now. There have been a number of tailwinds. What happens if we get to a period where HP still takes share, but they take share in a pie that's shrinking? You might not be growing at the same time. You could still see declines at the same time that you're taking share. And so, the bear case is much more kind of bigger picture, holistic kind of macro. Hey, these are end markets that are actually going to decline faster than they have, and you don't want exposure to a stock that has that exposure to those end markets. The bull case narrative is a bit interesting, and I would say historically for HP, we have been overweight HP. We were overweight in 2018. Again, and part of our equal weight is the fact that there aren't many catalysts going forwards, or hard catalysts. For the bull case, it's somewhat multifaceted. So one is you continue to have strength in the PC market. That's not necessarily a change from our view right now, but really where the change comes is there is a resurgence in printing volumes, meaning workers get back to the office, they continue to print. Yes, the market declines, but it does not decline as significantly as some of us think. And so you're going to have to see positive EPS revisions from that. And you're not necessarily HP. It won't necessarily be the worst exposed because you have a market that's performing better than expected. The other angle to it that's interesting is in February, or if I go back to November of last year, Xerox came out and they said that they were going to buy HP. Xerox is 3 times as small as HP. Unfortunately, coronavirus happened earlier this year, and Xerox, they were going to use their stock as currency to help buy HP. Xerox is now the worst performing stock in our coverage universe. They don't have that currency to go after HP, so that kind of special situations disappeared. The bull case is really some sort of return of the special situations, and it has to deal with 2 different parts. One is HP announced in earnings last month that they're now going to start buying back $1 billion of stock per quarter. If I can, kind of frame that means that over the next 5 quarters, HP can roughly buy back 15 to 16% of their total shares outstanding. If they can do that is obviously a tailwind to earnings growth, a tailwind to earnings revision. But the other angle is really, can HP take their strong balance sheet and perhaps turn around and buy Xerox? It's not necessarily something that I think HP is hyper focused on in the near term. They're dealing with forces in the printing and PC market that require attention. And Xerox, again, like I said, is the worst performing stock in our coverage universe. 85% of their revenue exposure is to the commercial or enterprise printing market, not a place you want to be right now. But there are paths towards, kind of synergies. I hate using that word, but essentially cost cuts. You can combine the 2 companies. There's a significant overlap. You can cut a bunch of costs, cut a bunch of people, and see EPS accretion because of that. Again, the reason we aren't overweight HP is because we don't necessarily see a high probability of that happening right now. There's other, as I would say, there's other fish to fry right now for HP. And so they have other issues that they need to deal with. But if you did see some sort of improvement in the printing business, and I would say a steeper improvement in the printing business, combined with the fact that there might be some special situations, meaning M&A or an acceleration in cash returns, then HP is a cheap stock that perhaps shouldn't be as cheap. And so that's kind of the bull case narrative that we would lay out right now.
Yeah. So that's how it's actually amazing to understand everything that you brought about the two companies, because HP it's cheaper, but it doesn't mean that's not a good thing. Although
exactly,
nobody wants to invest on typing machines. We understand the analogy, but it's amazing to see how Apple really got distinguished. So we can't just compare Apple to anything else. We don't even have companies getting to the point of becoming a $2 trillion companies right now, although we have FANGs really being highlighted in the US stock exchange right now. But we have to come to an end right now. I know it's incredible, but we've been here for 56 minutes already. And
time flies when you have fun.
We learned a lot of things here with you today, Eric. Thank you very much. Eric is here with us. He's the VP of Equity Research at Morgan Stanley. He's talking to us. He's talking with us from New York City. So thank you very much for your time, for your time, and for bringing everything you know. And thanks, Gizerma, for bringing him here too. And thank you for being here with us. Nobody left any questions because everybody is really overwhelmed for the subject. And here we just have a comment from Bruno that was watching us on the YouTube of XP, actually listening to the content in English. And he said that Apple can actually grow further because they enchant the clients. They just don't give the products. They really make us really overwhelmed about the company, and we just become very fans of the companies and the general. Yeah, it's really great. Thank you very much, Eric. Thank you very much for everybody. We just got
Thank you for having me.
Oh, don't say that, because we're going to you to come here all the time when we want to talk about these companies, right, Gizerma?
Exactly. Thanks
Next
so
time
much,
I'll come down
Anna,
to Brazil.
Yeah, you should. It was very insightful as always, Eric. Thanks so much for doing this.
Of course, thank you for having me.
Yeah. We're starting to have very interesting questions about the elections in the United States and how it would bring something to the U.S. stock exchange and things like that. But we cannot go further. I would like to thank everybody that was with us throughout this website, The Word in the Pocket. We got more of 10,000 new subscribers here in the XP channel. So I would like to thank you very much for that as well. And invite you to leave the like here in the video, and also subscribe for further contents. Thank you very much.
Thank you, guys.
Thank you all for watching.